Hey guys, hope everyone's doing really well today or tonight. I want to quickly discuss the best ways, or I guess some really great ways. Maybe there are some better ways, just depending on when you're watching this video. But as of current, the best way is to reduce tax in Australia. Now, by no means am I a tax advisor or tax professional. Everyone's situation will be different, and obviously, different things will apply to different people. But this is a more generalist video. This isn't um, this isn't tailored to anyone. This is really just things that, if you were to look on the ATO's website and look at, oh, what ways could I reduce tax? It's pretty much a simplified version of that, and a few other sources as well. So it shouldn't be anything groundbreaking. It's kind of just the basics for anyone that has no idea where to start. But obviously, getting specialized tax advice will be your best option. So anyway, let's get into it. Now let's go through some basics before we get into the details and whatnot. So Australia has one of the highest marginal tax bracket, or I said maximum tax brackets, but marginal tax brackets at 47%. And there's obviously some Medicare levy and some other charges along with that, but does offer a tax-free threshold. Now, what that means is essentially if you're a high earner and you're quite successful in Australia, you'll probably be paying close to 50% income tax on on kind of the the bigger part of your income, right? So, if you're earning, say, $500,000 from 150,000 or so onwards, that's when you're going to be paying that 47, that 50% range. Now, there is a tax-free threshold, which means at the earlier stages of your income. So, for example, when you're earning up to $20,000, I think it's about $19,000, you won't pay any tax, right? Which means everyone can essentially earn $19,000 or so and not be taxed on that. Going onwards from there, that's when, for example, let's just say there's a 10% tax rate from 19,000 to 29,000. Your income from 19,000 to $29,000 will be taxed at 10%, right? Now, if we then got the average between, your $0 income and then your $29,000 income, the tax rate would probably sit around 3 or 4% because you're accounting for about 20 grand or so worth of no tax, right? So, um, you won't if you're earning a lot of money, you're not going to be paying 47 to 50% just from the ground up. You'll be paying it based on how much you earn. So that bigger portion at the top end of the tax range, the tax bracket range, that's where you're going to pay the more tax, right? There are lots of options to reduce your tax, right? Including work deductions, structuring income different ways. Work deductions could mean something like, for example, purchasing some work boots, maybe some clothes, maybe maintaining those clothes, so washing them. Maybe if you're purchasing stuff for your home office, maybe that could include things like internet, desk equipment, maybe some notebooks, lots of different things. Structuring income, again, depending on your type of income source, employment income, or I guess earned income, will be at the highest tax range or tax rate of 47%. Whereas, for example, if you ran income through a business or a small business, you could pay between 25 or 30%, and that might work really well for consultants or contractors or people who operate their own business. Now, another way of structuring income could be, for example, paying money into your superannuation, or in America, your 401k, which would mean essentially that gets taxed at a maximum of 15%. So if you're working day to day and you're getting taxed at 47%, if you were to put that into your retirement fund, it will then be taxed only at 15%. So quite a big difference. Exemptions, there are lots of different you know, stamp duty exemptions and lots of different ways you can kind of reduce tax, especially around investments, but not really as much as earned income. Capital gains discounts, CGT discounts. Now, this could, for example, be when when you're investing in something over 12 months, you do get a discount of 50%. If you're investing in your own personal name, that might not be the same if you're investing through a business or through a different entity or a trust. But through your own name, you do get a 50% discount on any capital gains you've made, for example, in property or in the stock market. Now, what does being taxed mean, right? Being taxed means that you're making money, which is great. So it doesn't really make sense to avoid it. If you're someone who is worried about getting a promotion because you're paying more tax, I mean, ultimately, you will be in a better off spot than if you don't. Now, that means that essentially, if you do want to increase your income, you're ultimately going to have to pay more tax, right? There's no way to really avoid it. It just is what it is. Again, you might be able to structure things a different way, but if you're an employee and just getting promotion, 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 you're probably going to get to that 47% or 50% tax really quick. And there's not too much you can do around that, unless, of course, you kind of just structure things differently or maybe time things in a certain way. Even at the top tax range or top tax bracket of 47%, you're getting 47% on to the dollar back, not the whole amount. So what this means is like when people are saying, "Oh, it's a tax deduction, blah blah blah, it's worthwhile doing XYZ." I think what that really looks like is the fact that you're getting not everything back, right? You're getting a good portion back, but you're not getting everything back. So in my opinion, like things like negative gearing are a little bit confusing because it's like you are losing money, right, to invest in something that might be really great, but you're losing money, and the tax deductions don't really make up for it. You're still losing money. So ultimately, it's a little bit backwards. But if you can avoid tax deductions and just focus on earning more income, that will ultimately lead to a better result, generally speaking, all right, for the average person. Okay, your situation might be really different. You might include negative gearing in your strategy or tax deductions in your strategy, and that might be the reason why you're doing something. So, this is just generally speaking. Evading taxes is illegal. However, working alongside various rules can help you minimize taxes, right? So we don't want to evade taxes, and it's pretty tricky to do so, especially if you're an employee, because this gets reported to the ATO. But if you're someone who makes a lot of money through investing or have your own business, ultimately you're going to have to cop it. It means you're making money, but work with the system to see how you can pay less tax. Right? You don't want to evade because that's the wrong thing to do. Now, a few ways that you can reduce your taxes could be through salary sacrificing or contributing to your super fund, especially if you're a high earner. Now, if you're, for example, if you're in that 47% marginal tax rate bracket, each dollar that you're putting into superannuation, it's going from 47% to 15%. That's over. That's less than a third of what you'd be paying otherwise. So ideally, if you can make that work, or if that's an option for you, if that's part of your strategy, you're comfortable with locking money away, this could be working really well. Now, let's say if you're earning $19,000, $20,000, and you're paying $0 a year, right? Putting money into your superannuation would not be very smart because you're currently paying 0% and you end up paying 15%, right? So that wouldn't make sense. But again, the more you earn, the more and more it starts to make sense. There are a range of deductions for your PAYG employment or business activities. Speak to an accountant on this, but again, like I mentioned before, lots of work-related deductions. Ultimately, and what I've personally started doing is if I can not deduct something, I just because I'm not purchasing things, I'd rather have that option versus purchasing a million things because it might be better for my business, but it's ending up costing me more. Now, this doesn't apply, obviously, if you're genuinely requiring something, but this is more the good to have things in your life, right? Many people end up utilizing trusts, companies, or other vehicles to reduce taxes. This is what I mentioned before. This is different ways of structuring your income or timing your income or distributing income. This can get quite complex, but ultimately, if you're earning, if you're well into the 47% tax range, and you're looking to invest money, and you're looking to potentially start your own business or you already have your own business, looking into these different kind of structures can make things a little bit easier for you. You know, as a employee, earned income will be taxed at its highest rate, whereas there are other ways to distribute and time income and structure things that just will reduce taxes and have a more favorable outcome at the end of the day. Deferring income, for example, 10-year bonds or using the 50% CGT discount can work well too. Deferring income it could be like through a 10-year bond where essentially all earn all the capital gain or all the income from that bond becomes tax free. Another way to defer income is, for example, if you foresee in the next financial year that you're going to earn a lot more, it might be better off paying it or forward paying next year's expenses this year, um, or vice versa, right? So just timing your income, I guess timing paying your expenses so you can get the biggest tax deduction could be a good idea as well. The 50% CGD discount, I think it's kind of silly not to utilize that, not to try and hold your assets for at least 12 months. You can do short term flips and make some quick money, sure, but I mean, the amount of tax on that just could eliminate that really quickly versus just holding it long term. While you can reduce through, for example, negative gearing, you're losing more than you're benefiting. Again, this is what I mentioned before. I think negative gearing is a little bit of a weird strategy, encouraging you to lose money so that you can claim it as a tax deduction. Ultimately, you're not going to get the full dollar back ever with the tax deduction. It will end up costing you. And, the idea is earning more income will always have a better final output than tax deducting as much as you can, right? Focus on earning your income, and then the tax deductions can go alongside that when required. But you're not going to be tax deducting much or not getting as much benefit from it if you're not earning more and more income. Okay. Now, some other ways you can reduce your taxes, which are less commonly spoken about. Eligible Australian venture capital investments are exempt from income tax. Now, this is because the Australian government is trying to promote investing in startups. Now, you can look on the ATO's website. There's lots of different funds and investment vehicles that do exempt you from income tax or taxing on any capital gains, which could be really good. Again, they're risky, so it's not going to be like the S&P 500, where it's quite historically it's been quite strong and it's quite steady. Nothing like that. But do your research. You might find something that you really enjoy in that. Another option here is to move your tax residency out of Australia and obtain tax residency somewhere else. For example, the United Arab Emirates, Dubai, or somewhere like Paraguay, which is really popular nowadays. But essentially, somewhere that either does not tax income at all, it doesn't tax foreign income. So it might tax income that you earn in the country, but outside the country, it doesn't look at that. You might also be able to, get involved in some type of lump sum scheme or maybe some type of non-dom scheme. I won't get into these in detail, but essentially, lots of countries around the world will offer special privileges for people looking to move tax residency or move their residency over. And this can reduce your taxes from that 47% to around zero, or maybe that 5 to 10% range, which is obviously significantly better than even superannuation. So that could be an option as well. A business partnership with someone overseas being the majority owner. Now, how this works is essentially Australia has very strong how you say foreign controlled corporation rules, right? Which means that it's very easy for them to determine something Australian and then tax that. Whereas if you can structure something right, and you might be a a business partner, but you're not an owner, but you're benefiting heavily off that, you might be able to structure something where the other person becomes the taxee, someone who's taxed, and you're not, and you can kind of control that company in a way, and you're making good income off that without having to be subjected to Australian taxes. But again, speak to an accountant. This is very specialized stuff, and it can get very nitty and gritty between what counts and what doesn't count. Okay. Last point here. Investment strategies, for example, debt recycling, can introduce new tax deductions from your principal place of residence. So debt recycling is when essentially you're turning non-tax deductible debt, so something that's costing you out of pocket, and you're turning that into something that is deductible, right? And how that works is, for example, taking part of your mortgage, where you live, and turning that into a investment mortgage or investment loan of sorts, and investing in another asset, right? And that's how you can kind of turn that into a investment loan, and then obviously investments get tax deductions. So that's what you call debt recycling. Very simplified, but yeah, again, speak to someone if you're not sure what to do, or if you want to find out a little bit more about that. So yeah, hopefully you guys have enjoyed the video. If you have any questions, let me know down below. Make sure to like and subscribe, but otherwise, I'll see you guys in the next one. Peace.